Hey, it's Jeff Drake. I've got some information I want to share real quick. I want to set up a kind of a tee up or queue up a video I want to share with you, which, if it interests you, if this is something that has had your curiosity in the past, I can promise you, you will walk away with more knowledge than you may have ever imagined possible on a subject that you, like me, may have been misinformed on and maybe have your own draw and your own conclusions about. And it's a word. I'm going to share a word, and I want you to listen beyond this. I want to encourage you to listen for just a minute, because I'm going to draw a comparison I think it's a little bit funny, but you're going to gain some knowledge that will serve you in a tremendous way. I don't care if you're a young adult or if you're mature, more of a senior like me, or even older. This information, knowledge is going to be very valuable to you financially, educationally, information. It'll broaden your scope, if nothing else, on the subject so you can have an intelligent conversation. I find that most people can't have an intelligent conversation about this because they aren't knowledgeable enough. I wasn't, and I've got a lot more I'm learning, but I know a lot more than I did 5, 10, 15 years ago. So I can share the story with you. But the conversation is going to be around the word life insurance. Okay, that's 2 words, but it's a idea, life insurance. A lot of people think of it as a product. A lot of people think of it as just something for when they die. A lot of people have whatever opinions they have. Some people have been through a few different educational platforms or conversations with people and learned some parts about it. What I'm going to share with you now is more information than the average life insurance agent even knows about the industry they're in. And if they do know about it, they're not sharing it with you. And I want to share it with you. But here's the deal. I said that word life insurance. It might have turned you off. Some of you, they might already be gone. I already shut this off. But I want to compare it to another word. You can compare it against any generic word. Life insurance is a generic word because it's got 1,001 different possibilities as to what it can be done with, what it can mean to others. The word automobile, all right? Anybody remember the word automobile? Okay, what's automobile mean to you? Does it mean Honda, Toyota, Nissan? Does it mean Lexus, Mercedes, Audi, BMW, Acura? Does it mean Infiniti? Does it mean Bugatti, Lamborghini, Ferrari? Does it mean Corvette? Does it mean, what's it mean? What's it mean to you? Does it mean back in the day, Ford Pinto Mavericks, and when the Mustangs were first introduced by Ford, does it mean pickup truck? What's it mean? Sports car, convertible? Well, I'm going to give you a contrast here. And the point of it is there's even a broader contrast and interpretation, understanding of life insurance than there is in this. Does anyone remember this automobile? I'm going to show you this picture. See if I can show it in here. Anybody see that? That little red boxy looking car? Looks like kind of a squished together Volkswagen Rabbit back from the day. This is a Yugo. And anybody that remembers the name Yugo, mid to late 80s, came from Yugoslavia. And the sad thing about that car is the joke became, it was so independable, it had so many problems, started smoking, whatever happened. They said, you got a Yugo? That means you go nowhere. So you go nowhere became the joke about the Yugo, okay? And the idea was great, but it wasn't a wonderful automobile. And then there's this automobile. So this is a contrast of automobile. If you can see that, some people can recognize it, that and the glare as it is, though, that's a Bentley. That's a Bentley 2-door Continental. Quite a contrast, right, from quite a contrast from the Yugo. So my point is the diversity and breadth of difference between those 2 cars, there's even a greater difference between all types of life insurance. Here's the thing though, it'll cost you tremendously to not understand the differences. It may not cost you tremendously to not know the difference between a Yugo and a Bentley. And that's fine. If you like Honda or Toyota, terrific. If you like a Lexus or BMW, fantastic. If your dream car is a Corvette, beautiful. If you have a Corvette, even better. If you have a Ferrari, I love it. I want you to fulfill your dreams. And the purpose of a life insurance product and design is to help you fulfill your dreams. I'm going to share a video with you now that's going to educate you about what life insurance is and understand how it relates to the federal government and the controls they put upon it and how those can possibly serve you. What kind of benefits are there? So let's see if I can share my screen and share a video that I have on from one of the services I use. I have it on my website. I have an educational platform here with a lot of content on it. And let's see if I can get in here and share this with you. Here we go, right? My mouse will cooperate. Here we go. Let's get this video going. Let me go back to stop share and reshare so I can make sure that we get the sound coming through. There's a trick with Zoom. Many of you know you got to click that button before you share the screen. Here you go. Enjoy the video. I'll be back in about 10, 11 minutes.
The 10-minute lesson on life insurance. The client is looking at $500,000 of coverage. So let's talk about what they want to know about, which is basically, how does it work? How much is it going to cost us? So to begin, there's the minimum amount of premium that one can pay for $500,000 of life insurance protection. At the other end of the spectrum is the maximum amount of premium that one can pay for the same amount of coverage, in this case, $500,000. Now, who determines the minimum amount of premium for $500,000 of coverage for a person your age? Well, it's the insurance company. They have actuaries, and they calculate what's the least amount they can charge and still make a profit. They've got to make the product profitable. At the other end of the spectrum is the maximum amount of premium that one could put in a life insurance policy at a person their age for the same $500,000 coverage, and who determines that? Well, the federal government. The fact that the federal government is even remotely concerned about how much money someone would put in a life insurance policy says what? Well, it must be good. And it must be good in relationship to one subject, and that's taxes. Now, there's an infinite amount of product design between the minimum premium and the maximum allowable premium by the federal government. You could go meet with 5 different companies. They're all going to come back with different information. That's interesting. I'm getting ready to share some information with you that after today, you'll know more about life insurance than most agents, at least more than most agents are willing to tell you. So let's think about that a minute. Well, in the 80s, construction was completed. Basically, the government came in and the governor on how much premium one could put in a life insurance policy. They said, wait a minute. We can't allow people to keep putting money in life insurance the way they're doing now, because if they do, they'll be less likely to put money in the things that we want to encourage them to do. And what might those things be? Well, we called them qualified plans. Here's a few samples. I'm sure you recognize those. What do qualified plans do? Well, if I ask that question, many people will respond by saying, well, they defer taxes. So let's take a quick look. Well, they're right. They do defer taxes. They also defer the tax calculation. Let that run past your brain real slow. The government didn't say you don't owe us the money. They said that you can pay us later. I have a different word for you. It's called postpone. Isn't it amazing that the government didn't come out with tax postponement plans? It would be very easy to understand exactly what that means, that you're going to pay the tax later. Well, before you even get involved in qualified plans, there's certainly a question you need to be asking yourself. And that first question is, what tax bracket will you be in at retirement? Well, a lot of people, they have no idea. They go, well, how am I supposed to know? Well, Retirement Ready or Not can help you get the answer to this question very readily. If you have a saver, someone that's putting money away for their financial future, filling their savings and their investment tanks, balancing their current lifestyle desires with their future lifestyle requirements, there's going to be a good chance they're going to be in a higher tax bracket. However, if they're not saving, they're living like the spender and spending everything they make, it's probably a good chance that they're going to be in a lower bracket because they're going to have less access to capital. So helping people to understand that is very, very important. So that's the first question we want to ask. It's not that these plans are bad. They're not. You just need to understand what they do. What do? Well, they postpone taxes. They also postpone the tax calculation to later. So what tax bracket are you going to be in when you take this money? That's the question we want to help them get their arms around. The second question is, what deductions will you have when you take the money? It is quite interesting that during our working years, when we're, at the beginning we had less capital, less income, and over time it increased, we were looking for deductions. But now we get to retirement, most of the plans that people are employing in their retirement accounts are to have no deductions available, just in time to start taking the money. At what rate? Well, again, there's the big question. Okay, back to our story. So, what happened? Well, in 1980s, government put this governor in here and said, if you put more money in a life insurance policy than we're going to allow, it's going to become a MEC, a modified endowment contract. That simply means that they would start treating the life insurance policy like they treat qualified plans, with all the rules, regulations, and penalties. So a modified endowment contract with a life insurance policy is just like a qualified plan, meaning that you're going to have those rules and regulations that you're going to have to apply by. So the government was setting that limit of how much money one could put in a life insurance policy and still have those benefits. Okay, so let's continue. So let's assume that you could buy this policy for $500, or you could pay $10,000 for the same $500,000 of coverage. Well, being a good discount shopper, which one of those looks best? Well, certainly $500. And at $500, that's what we call term insurance. That's the least amount of premium for the most amount of protection. You get one benefit, and it is death benefit. At the higher end, $10,000 for the insurance company to talk you into putting $10,000 in a life insurance policy with a $500,000 death benefit that you could get for $500. They're going to have to come up with some benefits. Well, let's talk about the benefits for a minute, and let's forget insurance for just a second, because all money resides somewhere. You're going to have to put your money somewhere. So before we even get deep into the life insurance conversation about how a policy works, let's talk about the kind of benefits that you want from where you're going to place your money. Well, one of those benefits is going to be tax deferred growth. Obviously, compounding interest in a taxable account creates increase in your tax liability and lost opportunity cost. Tax-free distribution. Boy, that would be great. All right. How about a competitive return? Certainly people are looking for a competitive return on where they put their money. The ability to put in a bunch without being limited. Additional benefits, perhaps like suit protection, long-term care, critical illness, those kinds of things. Lots of benefits that people are looking for, of things that they'd like their money to do for them if possible. Here's a big one, collateral opportunities. And I utilize this resource, the underlying value of the resource, by being able to borrow it against it. I would like the money to be safe. I really like it in the safe tank as opposed to the investment tank, because these dollars are very crucial to me. I want to make sure that I can't lose them. No loss provisions, meaning contractually it says you can't lose. That would be pretty nice to have as a benefit. How about guaranteed loan options? If you ever want to borrow money against this value, you're guaranteed to get the money. You don't have to qualify. You don't have to tell anybody why you want it. It's guaranteed. That would be cool. How about unstructured loan payments? When you borrow against your underlying capital, you pay it back at your own pace. You don't have a deadline that you have to make a payment on the 1st of the month or the 15th. Liquidity, use, and control. Access to capital. Big, big benefit. And then finally, deductible contributions, which would be great if we could get all that. So there's our magic list of benefits. And obviously, when you're looking to put your money in an account, you would like the most of those benefits possible, correct? Okay, well, let's continue. So here we go. I want you to see, when we talk about life insurance, let's get back to life insurance for just a second. It's easy to think we want the most protection for the least amount of premium. That's term insurance, and with term insurance, you get one benefit, and it's death benefit. And the best day to own term insurance is the day you buy it. Because if you bought it today, signed the delivery receipt, and paid monthly, if you die on the way home from your agent's office, you can't get better than that. But my point here is that every day after the first day, term insurance is costing you more and more, giving you less and less because the face amount is fixed. Okay, so a lot of people, this is the level of life insurance that they understand. Let's go one more. There's another type of contract, and this is what I'm talking to you about today. I want to help you see. It has the highest premium for the least amount of coverage. Now that's a total opposite. Well, that means you put the most amount of money in for the least amount of coverage to make that money perform at its maximum potential. So let's look at our benefits again. Life insurance contract, putting in the highest premium with the lowest face, so all of these benefits start to grow. The higher you put the money in, the more money you put away, the better the contract grows and the more benefits you receive. Until eventually you get to the top where you cannot put any more in without going over that line, and that contract is termed a MEC contract as well, maximum efficient contract. A permanent life insurance policy where you put the highest premium allowed by the federal government to keep it from becoming a modified endowment contract and being treated like a qualified plan. The highest premium is just to that line without going over. And you receive all of these benefits at their maximum potential. Now notice the only benefit that doesn't come with the deal with life insurance is deductible contributions. All of the other benefits are there for you to utilize their maximum potential. When people understand exactly how life insurance works, they're going to want to put the most amount of premium they can with the least amount of face to make that policy perform as a maximum efficient contract.
Wow. Pretty powerful, right? Great information. To me, that was an eye-opener when I first saw it. My encouragement to you is to even watch it again, and particularly when he's going through the benefits. He's talking about it third party or abstract, but it really is discussing what is in a maximum efficient design of a life insurance contract. And the reason I'm even here in this space sharing this is after the 2008 market crash, I was extremely angry and frustrated by what happened with our retirement money, our 401ks, that we lost almost 50% of everything we'd worked for. And no one anywhere had a good rationale or solution or thought process leading into it, going through it, or coming out of it. And on a search of my own, I came up with some ideas of tools, products, services, places I could put some of our money so I'd never have to go through that kind of experience again. The volatility of the market is so frustrating to me. The whole idea of how little control that I had with money I would turn over to Wall Street really got to me after 2008. And I've never become comfortable with it again. Now, do I invest money in stocks? Certainly. Do I hold some assets? Do we have a fund here or there? Yes, some. But it's looked at completely differently. And I balanced what we do with other assets. And one of those asset classes happens to be a properly structured life insurance policy. And I set that up after the 2008 market crash, and that has served me beyond anything I could ever imagine. I did it because I wanted freedom and to avoid volatility. I wanted freedom of the risk, harm, and loss. And I wanted to know that that money was going to be growing every year, year over year, compounded for the rest of my life. And if something happened to me, there was a death benefit for my wife. But the main thing was what it did for us while we were living. And I didn't even understand all of that until fast forward several years later. I lost my job in 2017 and I needed resources. You know, I sold some of the stuff we had. We no longer had a boat, right? I got rid of one of my motorcycles. We liquidated a emergency savings account and some other assets. But the most important, most powerful, most accessible pool of money I had was the money inside of my properly structured cash value life insurance policy. And that kept our ship afloat. I went on to learn more about it and discover this as one of the aspects of all these benefits that I had that I didn't even know I had. So now my mission, my goal is to share it with as many people as I can, as much and as often as I can, to help them become educated, those that want to. If this resonates with you, I would encourage us to have a conversation together and talk about what it is that concerns you, because Don Blanton touched on these several benefits we have. They each radiate a magnanimous number of benefits within each one, things that you can do for yourself that are unbelievable. So anyway, I wanted you to see this video. I hope you liked it. I hope it was valuable to you, and I hope to hear from you. So we can explore the conversation and do what you want to do, which is to have the most success in your life, have the most financial stability, security, growth, return, have the most use and liquidity and access to your money, to be able to use it in powerful ways now, through your life, and on the way to the end of your life, and create a legacy with your life as well. This is a powerful tool to help you do that. Would love to explore that conversation further. Hope you're doing great. Hope we talk soon. This is Jeff Drake. Talk to you later. Bye for now.